got a couple minutes after 6, so let's go ahead and get started. Welcome everybody to our first webcast of 2022. I'm Jim Allen. I'm President and Chief Financial Planner here at Anchor Bay. And we've got a panel presentation for you tonight. You've got a big part of the team that'll be presenting. Our goal for this is to give you a brief recap of what happened in the economy, the markets, and taxes last year, and kind of where we see this year unfolding. But we really want to make sure that we're allowing a lot of time just to answer your questions. And we've had a bumpy start to this week and a bumpy start to the year in the markets, and so we want to make sure that we're available to answer any questions, any concerns you may have. So the way we're going to do that is we're going to hold all questions until the end of the presentation, and then we will open it up. So you can use the Q&A function on the toolbar there to ask your questions. We'll gather them all and we'll answer any questions at the end. So let me introduce our presenters tonight. There we go. Okay, so obviously I'll be one of the co-presenters. And then with us tonight is Tanner Risley. Many of you may know Tanner, but if you don't, Tanner is one of our main portfolio managers. He's also an investment advisor, so he works with some of our clients. Tanner's been with the firm about 5 years. He has a degree in economics from Harvard University. So we've got a really smart guy on the team here. And Tanner, in addition to helping set strategy and working with the investment committee, Scott and other members of the team, Tanner is the one that does all of the day-to-day trading. So when you need funds withdrawn from your account, Tanner's the one that determines where to generate those funds from. He's the one that does all our tax loss harvesting and our tax location. He does all the rebalancing. Tanner is pretty much the day-to-day person managing the portfolio, and he works with our advisors each week to discuss what's going on with your particular situation and changes the portfolio. And then with me, as usual, also is Blake Pinion. Blake is a financial planner at the firm. He's my right-hand person working on your financial plans. In addition to being a certified financial planner, Blake is also an enrolled agent. So he's one of our tax specialists, prepares many of your tax returns, does tax planning. So these are the presenters. We're kind of just going to tag team this. Someone will kind of take the lead on a particular section, and then the other members of the team will kind of chime in as needed. So let's go ahead and get started. So we're going to start with a market recap, and I'm going to let Tanner start this off, kind of let you know what occurred last year in terms of the markets, and then we'll dig a little deeper into some of the more granular details as we go along. So Tanner, turn it over to you.
Thanks, Jim. Yeah, last year we had a great year in the markets. All the major U.S. markets did really well. The Dow Jones Industrial Average up 18, S&P 500 up 26 and change, NASDAQ up 21 and change. International still, at least the developed side, did pretty well, not as well as the US, but very positive there. And emerging markets was negative on the year. As far as this year goes, however, like Jim mentioned, it has been a kind of a bumpy start with lots of volatility. To start the year this year, we're down a little bit. We're in pullback and on the edge of correction territory. So hoping things will start to even out a little bit, but we'll talk about why we're seeing that volatility and what you might expect going forward as we get in deeper to the presentation. So back to last year, the best performing sectors in the US were energy, real estate, and tech. I think a lot of people might expect real estate and tech to be up there. Energy might be kind of a surprise, and that's just because in 2020, the demand for energy and oil and, air travel and people driving their cars went down dramatically. And so those energy stocks got really depressed. And then as demand came back in 2021, they had a great year and outperformed all other sectors. The losers, and I say losers in quotes because you can see all sectors went up in 2021. These are the worst performing sectors, but you'll take 19.5% or 14% from utilities in any year.
Okay, so I'm going to kind of take this one. One thing that's it's kind of become apparent is, a lot of people will use indexes for diversification purposes, and we do as well. But over the past several years, what has happened is with an index, say the S&P 500, there's been a lot of the growth is generated by just a small handful of stocks. And it's maybe not providing the diversification that you think it is. For example here, almost 27% of all the earnings in the S&P last year were driven by 10 stocks, the top 10 stocks. And those top 10 stocks also account for almost half of the total market capitalization of all 500 stocks. So it's really become top heavy. And then there's a huge discrepancy between the valuation of those top 10 stocks versus the rest. For example, the top 10 stocks, what we call the price earnings ratio is a way to measure, is a stock fairly priced or is it, overpriced? Those top 10, which a lot of the tech companies you're familiar with, the price earnings on those is 33.2. The other almost 500 stocks, the 490, the price earnings was 19.7, which is more kind of a typical of a price earnings ratio. So this is kind of telling us that, the top part of the S&P 500, not only is it overweighting the index altogether, but there's a lot more risk with the S&P than there used to be. And we'll just show you this chart here. So this green line are the top 10 stocks in terms of price earnings ratio. This other line are the other 490. And you can see how those handful of stocks have spiked and gone up dramatically, where the others, yes, they've grown, but more typical of an average year in the equities market. So we just want to point this out that, using an index isn't necessarily the right way to go. And again, it's one of the reasons that we prefer to use individual securities, because we can control that, because these indexes, the way they're valued is weighted based on this market capitalization. So it's just a handful of stocks that are kind of skewing the overall portfolio returns and the risks of that particular index.
And it's important to note too that with a PE ratio, you want it to be lower. It basically is representing how many years in advance of earnings you're buying. So if a company has high price and low earnings, that's not good. That leads to a higher PE ratio. You want a company with a low price and high earnings. So you can see the 19.8%, that's actually, what PEs are supposed to look like, what their normal, what their long-term average is. 33 should tell you that those stocks are overvalued.
Okay, I'm going to cover this one as well. So this is where we stand right now. This is the S&P 500 that we were just talking about. And so as of the end of 2021, we were at roughly 4766. I don't know where we landed today, Tanner, but it's a little bit lower than that, by several percentage points. But you could see what's happened. This goes back to, roughly 25 years. And so, we had the nice climb in the late 90s. Then we had the tech bubble, and you can see that we had a pretty significant market decline, almost 50%. It rose back up, and then we had the Great Recession of 2006 to 2008. So you can see we dropped another 57%, and we've had a steady incline since then, absent one pretty significant drop for a very short period in 2020 due to COVID. But you can see it, for investors who were buying at the top of the tech bubble in 2000, took them 13 years to get back to their initial starting point. And, when we look at since that point, what the market's done, I think a lot of people kind of become complacent, just expect the market to go up and up and up, like this rocket ship that we see here. The reality is we have to anticipate these dips. And, our job as investment managers are trying to make those dips as, painless as they possibly can. We can't avoid them. They're going to occur. But, we want to try and minimize the pain from those dips. The other thing I wanted to point out in this chart is let's look at interest rates on 10-year treasuries. So back in 2000, the interest rate was 6.2. So if you were a retiree and you needed income, you're getting a nice income off those 10-year treasury notes. The income off that same 10-year treasury note as of the end of last year was 1.5%. Virtually the same as you were getting from dividends. That's been one of the drivers of this huge increase, is because if people needed income and yield and return, they weren't getting in the bond market because bond market interest rates had plummeted. And so that was one of the drivers of this huge increase. But so we just want to show you, this is where we stood at the end of the year. Now it's down from that high point. But the trend has been upwards for, 12, 13 years now. At some point, the trend is going to go the other way, like it did in 2000 and like it did in 2006. And like it did in 1987 when we had the big stock market crash. I don't know if there's anything you want to add to that, Tanner.
Nope, I think you did covered it all.
Okay. All right, so Tanner's going to cover the economy from last year.
Yeah, so remember to separate the stock market from the economy. The economy has to do with GDP, things like unemployment. So in 2020, obviously, we had the big shutdown and quarantine. And then in 2021, our economy improved a lot as we opened things up and had a full year of not fully back to normal, but looking a lot closer to normal than we did in 2020, certainly. Unemployment fell to 4%, which is below the 50-year average. And wages grew by 5.9%, which is above the 50-year average. The employment market is subject to laws of supply and demand, just like any other market, just like any industry. So when you have low unemployment, that's great. Everyone's working. However, for companies, it's harder to hire people. There's demand for new jobs, but there's not supply. There's not a lot of people out there looking for jobs right now. So what has to happen? Companies have to pay more for that employment, and that drives up wages. Then you've got interest rates. Last year remained low. The Fed didn't raise rates at all and had talked about not doing that until this year. And we'll talk lots more about interest rates as we continue through the presentation. GDP growth was 5.5, which is really good. That's a high number to see. It's typically around 3. Okay, so inflation, I'm sure you've heard about inflation in the news and everyone expecting inflation and inflation rising. Everyone knows what inflation is. It's an increase in the price level, increase in prices. So that includes, with the increased wages, unfortunately, that means also everything that you're going to buy is going to cost more. Inflation spiked to 6.9 at the end of 2021. This was brought on by a number of things. The main driver was the supply chain issues, and everyone likes to point to the example of all the cargo ships off the coast of Long Beach trying to get in to unload all of the things that people bought. We also got the spike in energy prices, also due to supply chain issues. And then low unemployment rates, which led to higher wages. So with more money in the pocket of consumers, prices were able to rise, and now we have inflation.
Okay, so I'm going to cover the slide here. So that blue line is essentially, inflation overall, and you can see where we are. You can see over 2011, 13, 15, 17, 19, very long period of time. Actually, I mean, you can probably go all the way back to the 90s. Inflation was pretty low. I think a lot of people have forgotten that we've had periods of high inflation. For example, the first home I bought was in the early 80s at a 12.5% interest rate. And so people have just kind of forgotten about inflation. And this is the first time it's kind of, reared its ugly head in quite a while. But there are differences between the types of inflation. On here you can see the energy inflation is what really jumped 33%. Again, that was, a lot of it was nobody was driving or traveling in 2020, and now there's a lot of demand, and there was also supply chain issues. So, energy prices spiked. Food was expensive. Core CPI was expensive, and so overall we had a big jump in inflation at towards the end of 2021. The question is that a long-term trend, or is it a transitory thing? And Tanner will talk a little bit more about that. And if you want a little more information, we wrote a blog piece on our website last month on whole inflation and the whole supply chain fiasco, et cetera. So you can go get a little more detail on our website in that blog article if you like.
So the 2022 economic outlook, we'll go through some positives and then some negatives. On the positive side, you've got the infrastructure bill hitting the economy. That'll, again, create more jobs and more money in the pocket of consumers and increase our efficiency as a society, hopefully. Omicron could be peaking with, we're not seeing any worries of closures on the horizon, which is good. When we say peaking, we basically mean the virus has mutated to the form that it wants to be in, which is where it's highly transmissible and it's not killing the host fast. Obviously, if a virus kills its host before it can pass on to the next person, that's actually somewhat inefficient for it. So it's basically moving towards what we always have with flu and the common cold, and it just might be one of just another thing that we have yearly vaccines for, or but nothing that is going to shut down the economy, hopefully, in the near future. And then we have consumer demand very high. The question is, when will the supply chain issues get resolved? There's a lot of mixed thoughts on this, when that might happen. But basically, there's a ton of demand out there. And when we see the supply finally catch up, company earnings will grow and stocks will go up with it. It's just a matter of when that actually hits, is still kind of up in the air.
Yeah, I think we were thinking, maybe we're kind of, there's some light at the end of the tunnel on the supply chain thing, but now China's kind of shutting everything down again because of their Omicron fears, which may create another supply chain holdup over the next few months. I mean, you could see it, for example, the price of cars. They can't build new cars because of computer chip shortages. So there's demand for used cars. There's not enough used cars being sold. So, prices are spiking. Hopefully this will all sort itself out over the next few months, but we may be in for another wave of potential supply chain issues in the short term because of Omicron.
Okay, and on to the negatives. So as we talked about, rising inflation. Now, again, remember to separate the economy from the stock market. In the short term, rising inflation can actually be good for stocks, because you want to be when prices are rising, if you're in cash, you're obviously losing buying power. However, if you're in stocks during inflation, you hopefully will get the growth that will offset any kind of inflation that we're seeing in the economy because those companies are growing with it. So in the short term, inflation isn't necessarily going to be a bad thing for stocks. There's a lot of other factors, but you can't equate inflation to, okay, that means the stock market's going to go down. With that being said, with inflation, the Fed is going to try to combat this and make sure that we don't get crazy inflation, hyperinflation. So they're going to rise interest rates. And this slows down the economy. You think about companies that are trying to, maybe they're thinking about opening a new plant or investing in some sort of research and development, and they're thinking about getting a loan to do it. Well, if it costs them more money, they're going to think twice about maybe investing in that, and that kind of thing slows down the economy. And Fed tapering. So this is basically how they're going to start to raise interest rates. And we'll talk about exactly what tapering means. But for now, the Fed is in that tapering mode, and they should be basically done tapering in March, and then we might get some interest rates following that.
Okay, so let's kind of talk about what's causing the spike in inflation. We briefly touched on this. It's kind of two factors. It's those supply bottlenecks. It's all of those ships that are sitting off the port of Long Beach, which they're still there. It's hopefully improving, but it's still there. And it's low unemployment. As Tanner said, it's supply and demand. If we've got a need for workers and there aren't workers available, then employers have to raise salaries and hourly rates and offer better benefits and things like that. So that obviously they pass those increases along to the consumer in terms of increased prices. And so as an example, right now there are 3 million more job openings in the US than there are unemployed workers. So there's definitely a lot of demand and limited supply. Part of that is this, what it's kind of been called in the news, the Great Resignation, where a lot of people they lost their jobs, or they just kind of reevaluated their life during the whole COVID pandemic and decided, you know what, I'm going to try something totally different, or I'm going to take some time off. And so that's partially created the shortage. A longer term trend, though, is that the baby boomers, and we've been talking about this for years and years, how demographics are going to impact things. The baby boomers are hitting that age where they truly are retiring. They're retiring older than their parents' generation did, but they are starting to retire, and there aren't enough younger adults that are joining the workforce to kind of replace them. So those two factors, that there's tons of jobs out there that can't be filled, and there's the working population is starting to shrink, has created the situation where people are going to have to raise salaries and et cetera, which are going to get passed along to the consumer. Now, the other thing is the supply chain issue. That truly is transitory. That will ultimately get fixed. Now, it may be delayed a little longer than we had planned because of this Omicron spike, but that will be addressed. So this large spike in inflation probably is going to level off, but demographics will probably indicate that we are going to have a little bit higher inflation in the future. And so the impact of inflation is, as I just mentioned, it's good for income. There's plenty of jobs out there. Employers are going to start raising salaries. You're going to get cost of living increases. So that's the good news. And if you have Social Security, for example, this year you got roughly a 6% increase in your Social Security benefits. If you have pensions that have cost of living increases, you probably saw a similar cost of living increase for those. So it's good that wages are rising. On the other hand, expenses are going up. I mean, we could see just with, the price of cars, as I mentioned, the price of used cars, the price of gasoline, things like that. So the question is, will these salary increases and higher wages, et cetera, offset those spikes? Probably not immediately. And so we probably see an erosion of income in the short term as the expenses are going up faster than the salary increases and things like that. Again, we think that the spike will taper a little bit and just become a steady trend. And in that case, maybe they'll balance out. And we expect inflation not to be crazy, but to be kind of slow and steady. So I'm going to turn it back over to Tanner to talk about interest rates and the Fed.
Right. So the Fed uses interest rates to slow inflation. And in the reverse situation where we have rising unemployment, they might lower rates, which is what they did immediately as soon as we shut down in COVID. They were in a raising period, and then they said, okay, the economy's in trouble. We got to lower interest rates. So rising rates slow economic growth. Money will become more expensive and fewer people and companies borrowing. So interest rates are basically just the cost of money, and the Fed is the baseline for all interest rates. They create with the Fed funds rate. They basically set the low bar, and then every interest rate from there just goes up. So you've got the Fed borrowing with banks, and then you've got the interest rate that the banks borrowed from each other is going to be a little bit higher, and on and on and on until you've got loans for, individuals buying a new car or mortgages, or then you've got at the very tail end of it, credit card interest rates. You can expect everything to rise when the Fed makes their first move.
Okay, so this chart just kind of shows you where we are with interest rates. So let's look at starting in 2016. Interest rates had been virtually zero for a long period of time as we came out of the Great Recession. The Federal Reserve started ratcheting up rates. Again, not high. I mean, we're still well below 3%. But then COVID hit, and you can see they cratered and they went to zero again. So this is where we are. And we don't know exactly which path it's going to take. But at some point, the Federal Reserve is going to start raising interest rates incrementally over the next year or so. And so their target is to get back to kind of roughly a 2.5% rate, which is enough inflation so that they can, essentially keep their deficit in check and things like that, but not so much that it's going to crater the economy. It's a balancing act, and we'll see if they can pull it off or not. So far over the last decade or so, they've done a pretty good job of balancing this so that they keep the economy going without causing a recession.
And additionally, once they've raised rates, right now where we are, interest rates they're basically pegging an interest rate of 0 to 0.25. So it's basically, it's zero. It's near nothing. The Fed doesn't have, if we go into an economic downturn, that's their main tool to save us. And right now they don't have anywhere to go. So it is healthy if they can get a little bit of a gap in there while the economy is doing well, while we're growing and prices are rising. If they can slowly rise interest rates, it'll give them a buffer in the future in case we ever get into trouble. They can go right back to that, lower rates, and hopefully save the economy from a downturn as big as it would have if they had done nothing. Okay, and so now we're going to talk about what is tapering. So the Fed has been buying treasuries since we got into COVID. So they lowered interest rates to zero, and they're buying treasuries. So the Fed is taking money that was not in the economy, and they're buying treasuries with it, and therefore putting it into the economy. This helps, increase the money supply and keeps interest rates low. So back at the end of 2021, the Fed declared they're going to slow their rate of buying. So they haven't even stopped buying yet. They're still buying treasuries. They're just slowing the amount that they're buying. They're slowing the rate at which they're buying. That's what this tapering is. It's the slowing of their buying. And the market expects, and the Fed has hinted that this is going to stop in March. That ending of the buying will shorten money supply. And at that point, we'll see they might start to raise interest rates. Okay, so interest rates for 2022, as we've said, tapering. Once tapering is concluded, the Fed is going to start raising rates. The market is expecting 3 to 4 rate hikes this year. Typically, the Fed raises in 25 basis point increments, or 0.25% at a time. They can do 50. They can do even more if they want to shock the market. But typically, that would result in a lot of volatility in the market, which they don't typically want. So they'll most likely raise it by 0.25 or maybe 0.5 at the beginning. But if they did 3 to 4 rate hikes at this rate, that would mean we'd get possibly a Fed funds rate of 1% or even more by the end of 2022, which we haven't seen since before COVID.
Right. I mean, we showed on that other chart, right now the federal fund rate is 0.13. And so, 4 increases of 0.25% each year, like 1.13, which is still really on the low end.
It is.
Of the scale. But as Tanner mentioned, I mean, this is the tool to help stimulate the economy. Our interest rate decreases. And they've kind of put themselves in a corner when they went to zero, because if we have a slowdown, they can't fix it with interest rate decreases because they're essentially at zero. Just today, the Federal Reserve met and they announced that they're not doing a rate increase right now. They left rates unchanged as of the moment. And I believe they mentioned that the first one could potentially be in March as they unwind the tapering and stop buying the treasuries.
Right, and some of this has caused some of the volatility, even though the Fed is doing pretty much what the stock market is expecting them to do. It's this kind of waiting period, this uncertainty of when are we going to get the rate hikes? When are we going to see this? How is the market going to react? I expect that once the Fed actually does raise interest rates, the market has been expecting this for so long. I think it might be a breath of relief for the stock market. Like, okay, they raised interest rates, the market didn't crash, everybody's fine, and it might actually smooth out the volatility. But in the meantime, if the Fed sticks to what they've said and they don't raise interest rates until March, we could get a lot more of this up and down volatility in the stock market.
Yeah, and so let's talk what this may do to the housing market too, because the housing market is especially sensitive to interest rates. Because rates have been so low, we've had the boom in the housing market. The cost of getting a mortgage has been really low. People could qualify because of lower rates. And so we've had kind of potentially a bubble in the housing market. So if we have interest rate increases, that will make mortgages less affordable, which means fewer people will qualify for them or be able to afford them, which potentially could flatten or drive down prices. As an example here, let's just say we have a 30-year loan on a $500,000 mortgage. We have a 3% mortgage, which is right around where you are today. Your monthly payment would be $2,100. If interest rates went up to 5%, and again, in the scheme of things, 5% for most years is a heck of an interest rate. I think 10 years ago, everybody would have been really happy to have a 5% interest rate. But at that, the same mortgage is going to cost you about $570 more. and which means that it'll be harder to qualify. And people's ceilings in terms of the price they're going to pay for a house will be decreased. So it could potentially slow the housing market. Also potentially slow commercial, borrowing and buying and things like that. So we've maybe seen a trend where the hot housing market's leveling off a little bit anyway. Maybe we're reaching the point of diminishing returns. But we don't expect a huge drop in housing prices like we saw in 2007, 8. But we could expect that maybe this housing bubble will level off a little bit as interest rates start to creep up. Even if they go up 1% over the year, that's still a very reasonable mortgage rate when you're looking over a 30-year time horizon.
So what does this mean for your portfolio? And with regards to bonds specifically, when interest rates rise, bond prices fall. If you think about, if you're holding a bond that's paying 3% and interest rates rise, and now that same company, that same bond is issued and it's at 4%, well, what's the market want? Do they want your bond at 3% or do they want the new one where they're getting 4%? If everything else is equal, they're going to take the 4% bond, and your bond price, if you tried to sell it, is going to go down until the interest is actually equal to 4%. So that decrease in price is what you see when interest rates rise. And this is more severe on the longer term bonds. So a 10-year bond will see a much higher price fluctuation when interest rates rise than the shorter bonds. But the good news for interest rate rises is the interest payments on the new bonds, like I said, will increase. So when your bond matures, we can take that money and now invest it into a bond that's paying more. And the way we run our portfolios, we're not trading bonds before maturity. We buy bonds to hold until the bond matures. So you might have a bond that's due in 2023. We're planning on holding that until it matures. So the price might fluctuate. It might go down in the short term, but as it gets closer to the date of maturity, it'll rise back up and mature at what's called even par. And that's how we buy bonds. We don't worry about the short-term fluctuations. We're holding them until maturity, and then once that matures, we can go out in the market and buy at market interest rates, which should be this year higher. So that's the good part, is we're able to get more income from your bond payments, which means we can take a little bit less risk and maybe take some of the work off of stocks. For those of you who need income that we've been looking to stocks for, maybe now we can move to bonds, which are typically safer than stocks.
Yeah, and one thing to consider there is this is one of the main reasons we don't use mutual funds. Because if you have the individual bond, then we can hold it until maturity and not worry about price fluctuations. If you have a mutual fund that has bonds, that portfolio manager may buy and sell bonds at different times, and you do see price declines. And so we typically like to use individual bonds whenever we can. Now, there hasn't been great values, so it's been hard to find them. But our approach is typically to actually own the individual bonds, so we don't have to worry about price fluctuations.
Okay. And so what about stocks? As rates increase, stocks will fall and investors return to the bond market. So this is what I was just saying. If you have a need for a 3% income and bonds are only getting 2%, well, we might have some in bonds, but then we're going to have to go out and find some stocks that are yielding 4% to make up for that gap that we weren't getting in bonds. Well, as interest rates rise, bonds will eventually get to the point where they're meeting your income needs, and now the market, and this is true for any investors out there, the market will start to shift and use those bonds because typically bonds are safer. And so once we get to a certain point, once interest rates rise high enough, we will see a shift out of stocks. And so we do have to be careful, because in the short term, you want to be in stocks because you don't want to be in cash. You don't want to be in bonds in the beginning when interest rates are rising and bond prices are going down, and you don't want to be in cash because you're losing purchasing power by just sitting in cash when everything around your cash is getting more expensive. So in that case, you want to be in equities, but there's going to be a fine line to toe where at some point the market will say, okay, these bonds are yielding enough. We can shift out of equities and go into bonds, and you don't want to get caught over in equities when that happens. So I don't expect that to happen this year, but at some point there will be a shift, and we'll have to be careful about where we are, and we always are. We're very, tuned into this stuff, so so that we're not caught, in the wrong spot. Okay, so just kind of to recap here, and this is having to do with the stock market specifically. Headwinds, meaning these are things that are typically bad or might hinder the stock market. You've got the Fed tapering and the interest rate increases. You've got inflation, which can be good and it can be bad for equities. You've got COVID uncertainty, which we are hoping that there's no, we're done with the lockdowns and we're going closer and closer every day, hopefully, to life as normal. And then you've got tax law changes, which might hinder stock performance. Then you've got, on the tailwind side, strong consumer demand, hopefully supply chain improvements at some point. Are we at the end of COVID? We don't know yet. And the infrastructure bill, which was signed into effect last year, but we knew there'd be a lag before we actually see the fruits of that bill. So hopefully that will be hitting this year. And then also we have Ukraine as well. And, typically the market hasn't reacted strongly to international politics. So when the stuff with Russia and Ukraine came out, the market basically ignored it. So hopefully that is the case, and hopefully that doesn't escalate, but it could be something to watch out for in the future.
All righty. So some current market fads, and I'm sure all of you have been reading this in the news, seeing it on TV, what's going on with cryptocurrency, what's an NFT. So I'll do my best here to explain what each of these fads are, and then I'll give our 2 cents from Anchor Bay Capital to how we view these fads and how they fit rather within the context of a portfolio and financial plan. So let's just start out with cryptocurrency. So you might have heard it as a digital currency, digital gold, digital asset. Essentially, it's a digital currency. The 2 prominent ones are Bitcoin and Ethereum. There's a full suite of other different types of cryptocurrencies. It seems like every day they're coming out with a new cryptocurrency. I'm sure you've all heard of the Dogecoin era. With initial coin offerings, they're coming out with a lot, but Bitcoin and Ethereum are the main cryptocurrencies. Like a stock or a bond, they can trade and be held at institutions. Primarily cryptocurrencies held at Robinhood or Coinbase or BlockFi or Gemini. And then they're traded just like a stock and a bond. But the main point about cryptocurrency is it's volatile. And that's why it's dissimilar from a stock or a bond, because of the fluctuations. And I'll give you an example. Back in November of 2021, cryptocurrency topped out at an all-time high of $68,000. Today, it's hovering around $37,000. So it's it's lost roughly half of its value in 3.5 months. So it doesn't provide that stability that a currency is supposed to support. It doesn't have a spot price that's equivalent to the dollar, to where most really have some hesitation to why it's called a cryptocurrency, because of the major fluctuations. So it's had big run-ups, but it's also had big run-downs. And kind of our stance on it here at Anchor Bay Capital, we're definitely observing it. We're doing research and seeing, hey, does it have some application as a diversifier? Because it has been proven to not have too much correlation to the stock market. So we're seeing, hey, does this fit within a financial plan and a portfolio? At this point, we're not managing cryptocurrency for our clients, but those of you that do have cryptocurrency would say, be aware of the risks and be aware of the possibility of losing your initial principal, the money that you put into it. Just understand the money that you put in could all be wiped away within a day, because the market trades 24 hours a day, 7 days a week, unlike a traditional stock market. So be comfortable with the risks, and we'll continue to do research as a company on it to see if it has some applications. So blockchain. So there's blockchain in a nutshell is really a type of database or technology to make things easier and better, for lack of a better word, trying to simplify it. So there's two types of blockchains, the public blockchain and the private blockchain. So on the public blockchain, this is where we're hosting Bitcoin. So Bitcoin has its own blockchain. There's a Bitcoin blockchain, and then you have an Ethereum blockchain, and then you have different other types of blockchains for the various coins. So those public blockchains hoist the cryptocurrencies. On the other hand, you have the private blockchains. This is where you have the major companies stepping in, like the big banks and the other types of companies, where they're private, so they have shared private keys, where the consumer, such as myself, cannot access a private blockchain. And these companies utilize the private blockchains to make their operations more streamlined and efficient, really cut costs or cut out the middleman. So we believe blockchain as a whole has a lot of application in the underlying technology in order to streamline things, make things more efficient, utilize that type of peer-to-peer network. As it's decentralized, it doesn't take into account a big bank or other type of centralized system. So we really like blockchain and its technology and the future application. So as a company, we're looking into some types of companies that are exploring blockchain or implementing the type of blockchain technology within their suite of assets and portfolio. So NFTs, non-fungible tokens, I'm sure you heard of this as well. They're essentially types of digital assets, so digital graphics, digital art, digital music, digital brands, digital pictures, digital videos that I myself could put up on the internet and sell to someone else, or what we often see celebrities or professional athletes sell these types of NFTs, non-fungible tokens, to others. The key word about non-fungible tokens, non-fungible means unique or can't be replaced. So the power of an NFT is its rarity or its scarcity. So if I'm a professional athlete and I put an NFT on the market that no one else has access to because it's one of a kind, it's going to be highly valued because of that supply and demand factor. On the other hand, a fungible token, that's a cryptocurrency. If I have one Bitcoin, I can trade it to you as another Bitcoin. That's fungible. Non-fungible gets its name because it's coined for its uniqueness. So that's kind of NFTs. Again, we're researching them to see, do they fit in within a portfolio, or are they just a fad as they're blowing up these days?
Yeah, just a couple comments on cryptos and NFTs too. The difference between those and say a stock is a stock, you're typically investing in a company that has profits and financials, et cetera. Those kind of items are much more of, say, like a piece of artwork. The value is in the eye of the person who wants to purchase it. And so you can't really tie it to earnings or something like that, like you can with a traditional investment. that's what makes them so volatile and speculative. And that's why you don't know in the long run which ones will be winners or losers, because it's all based on whatever someone's willing to pay for those assets.
Correct. Yeah, there's not much underlying value in the actual, currency or NFT. I think we remember the Beanie Baby era. Beanie Babies used to be popular, and then we know now that that was just a fad. So the Series I bonds, and these are getting a lot of buzz these days. They're inflation protected bonds issued by the U.S. Treasury. So they're short-term debt securities, and they have very low risk, and you can buy them directly through the U.S. Treasury. Why they're gaining a lot of interest right now is because they're paying 7% for a very low risk in type of investment, a low risk bond. And they're paying that due to the recent spike in inflation, as we talked about tonight. The caveat with Series I bonds is you can only buy $10,000 worth of these Series I bonds, and you have to hold them for 12 months, like a CD. But it definitely makes sense that we've been talking to some of our clients about this, to carve off small slice of your portfolio, $10,000, and get $700 in interest for a relatively low risk investment compared to what you're going to be earning at the bank. Gold, historically, it's been denoted as an inflation hedge, but recently it hasn't performed up to the standards that people think gold would kind of hold up due into the inflationary environment. Again, we probably think it still makes sense to incorporate in a portfolio as a type of inflation hedge and diversifier, but right now it hasn't done that well in the past compared to what it's done historically. And then finally,
I'm sorry, another comment on gold too. We get a lot of questions about people asking about that. The issue is, let's say you're a retiree and you need income. Holding gold doesn't create any income for you. And so, there are other inflation hedges like stocks that could provide income through dividends, et cetera.
Yeah, absolutely. So ESG, that stands for environmental social governance investing. So this is a new trend as well, as consumers, investors, they're looking to put their dollars to work in companies that are upholding these ESG principles or values. So they want to invest in, the companies that rank high on this scale of, giving back to the environment, upholding social values. So there's some types of companies that are recorded on the scales that exclude tobacco and different type of drugs and stuff like that. So the higher ranked up on the ESG scale, but it's just a way for people to align their money with their values. And there's some ways to do that within a portfolio via direct indexing.
Okay, and so we've got a few slides here to wrap up on the investments before we get to the tax part of the presentation. In 2021, last year, tech and growth led the way. We expect to see this shift in 2022 to value. Stocks that have strong financials show strong earnings at low prices relative to others. So this kind of goes back to that PE ratio that we were talking about, amongst a lot of other metrics that we'll look at to see what companies are earning, are showing strong earnings right now. And this matches what our investment philosophy is. Growth in tech and that space is a lot harder to predict. You are banking on future earnings, whereas with value, you can look right now and see how a company is doing. We're looking to potentially overweight companies selling hard assets, right? So if prices are rising and you're a materials company, you sell, like, let's say steel, you just in holding those assets, as prices rise, you're going to be able to sell that steel for a higher price. And so typically companies like materials and energy, anything that has an actual good that it's selling as opposed to tech where it's mostly services, those ones we expect to outperform this year in a shift from what we've seen last year and during COVID. overall, we anticipate moderate gains this year. So the stock market knocked it out of the park last year. We still expect it to be up this year, just maybe not quite as much. And so our strategies, still dividend investing is very attractive as rates rise. Lots of companies will increase as their prices increase, as they're able to sell at higher prices, they can sell their goods for more money. As everything gets more expensive, they will increase dividends to follow because they'll get higher earnings from the higher prices. And to keep up with the price level, lots of companies that we invest for our clients who need income know that that's where their investors are. Companies who have done dividends for a long time know that people are investing in them for their dividend, and they want to keep that. So they'll increase their dividends over time to keep up with inflation, to keep up with the rising prices. And diversification is always a key strategy. Again, even though we might overweight some sectors as opposed to other ones, we still want to have a broad level of investment over the entire market, so that if one sector or one company doesn't do well, we've got other ones to prop it up. So you don't have all your eggs in one basket.
And just to kind of show you this, we'll look at that bottom chart there. So this is the returns over the last 20 years by asset classes. And you can see the top performer over the last 20 years has been real estate, roughly 10%. Then emerging market, then small cap, then high yield bonds, then your typical equities, the S&P 500. Now those first four have the best returns, but at the same time, they also have the highest risk. And so you've got to take risk and return into consideration. So what I want to point out with this one is that those two blue bars are diversified portfolios. The light blue is a portfolio that's 60% in stocks, 40% in bonds. And then the darker blue is 40% in stocks, 60% in bonds. If you compare that 60-40 portfolio that averaged 6.4% over the last 20 years, it's only 1% below the S&P 500 with far less risk. So that really points out that, diversification, makes a ton of sense, because you can get close to the same returns with much less risk. Now, if you look at that orange bar, the 2.9, according to a study by Dalbar, which is an organization that does these kind of studies, that's what the typical investor got. And so, they're barely beating inflation. And so the key is to, have proper diversification, stay within, your time horizon or risk tolerance, et cetera. And, having some bonds in your portfolio may not be sexy at the moment, but in the long run, you can see it provides pretty good returns with much less risk.
Right, and so here's a great slide that shows you exactly what Jim was just talking about. You can see the white squares, basically the black, that trace the black line here, starting from 2007 on the left all the way over to 2021 on the right. It's basically in the middle, and you're never too high or you're never too low, and this helps with your psyche, and it helps you not sell at low points, because you're getting basically the median level, but still way outpacing inflation and getting growth there. Another thing that I want to just mention on here is, we kind of talked about commodities. Lots of times commodities are a good place to go in inflation. If you think about it logically, you want to be invested in something, like Jim used the example of cars. They happen to be going up right now, or oil, gold, maybe, in the past it goes up as inflation goes up, but it's also extremely risky. I mean, look at where commodities are in the dark green. Look at how many years they're at the very bottom. Look at how many years they're in the negative. So if you get it wrong, you're giving up a ton. I mean, in let's see, in 2015 or 2012 through 2015, it was the worst performing area that you could be in. And in fact, since 2007, it's averaged annually negative 2.5%. Whereas the stock market, the large cap, basically what you might consider the S&P 500, has averaged 10.6%. That's a huge difference, and you'd really be kicking yourself if you were in commodities that entire time. So it's a really high risk to try to play that game where you go into commodities because you think, prices are going up, so I need to be, somewhere that traditionally has done well in inflationary periods. But what if it gets, what if you get that wrong? And so the asset allocation is the way to go, where you can stay on a nice even upward trend without the crazy swings that you see in an area like commodities.
Yeah, so one other comment on that too. If you look at those last two columns, commodities is at the bottom in terms of annual return, a negative 2.6, as Tanner said. But look where it is in terms of volatility. It was the fourth most volatile or risky investment. So not only did you not get a great return, you got a negative return over that time frame, you were also in one of the riskiest investments you could be in. So diversification really can help smooth that out. And
Yeah,
it
and
makes
look
it
where asset allocation is. It's at almost the very bottom.
in terms of volatility.
Right.
Okay, so at this point, we're going to shift gears. We got a few more slides, so hang with us a little bit longer. Blake's going to talk about some of the tax stuff that's occurred or may occur this year, and then we'll open it up to take as many questions as you guys want to ask. So
Yeah,
Blake, take it away.
Great. I'll quickly run through it. So you've probably seen in the news this new proposal called the Build Back Better plan. It's hard to say more than one time. It did not, in fact, pass in 2021. It almost got close to being pushed through near the end, but it did not. There was disagreement between Congress on some certain provisions there. So the future does remain uncertain for 2022, whether this proposal will get resurrected. It could potentially be broken out into bits and pieces, and some specific provisions within it get passed. Two ones that I'll highlight here. The first is the backdoor Roth. And I know this affects some of our clients, and people were concerned about this, but they were talking about eliminating the backdoor Roth contribution and eliminating the after-tax contribution to 401ks. If you're not familiar with the backdoor Roth, you're basically contributing non-deductible money to an IRA and then immediately moving it into a Roth. So this would affect a good amount of people if it did get pushed through, that you can no longer do this. And then the second one, which is definitely huge in California due to the high property taxes we pay and high income taxes we pay, is the state and local taxes limitation and raising this. So right now, we can only deduct $10,000 for state and local taxes. That's your real estate taxes and your income taxes primarily. That's capped at $10,000. They were talking about in this Build Back Better plan to increase that to $80,000. So that would be a win for a lot of us as taxpayers. Again, it hasn't not got passed, but we'll keep an eye out for it. So right now there's no current changes to tax law. Again, we'll just have to wait and see if anything comes to fruition. But there are some temporary scale backs on some things that got implemented with the America Rescue Plan, which I'll talk about next. So with the America Rescue Plan, they had a nice benefit for individuals that have kids. They extended the child tax credit. They increased it from $2,000 to $3,000 and $3,600, depending on your adjusted gross income. That's going to go back down to $2,000. So it might mean come April 2023 that you have you're not getting as much as a refund. And then they're going to end the $300 and $600 above the line charitable deduction. Again, this is going to be enforced for tax year 2021. We're talking about tax year 2022. And then again, the last point that got passed in the American Rescue Plan was the charitable deduction. Previously, you could contribute 100% of your adjusted gross income as a cash contribution and deduct that. That's going to be reverted back down to the 60% threshold. Okay, so it's just some updates with numbers here for year 2022. So the standard deduction got a bump with inflation, rising to $12,950 for single, $25,900 for married filing jointly. The IRA contributions, that hasn't changed, still $6,000 if you're under the age of 50. If you're over the age of 50, you get that catch up of $1,000. You did get an increase in the elective deferral to a 401k. So if I'm an employee of a company, I can now contribute $20,500 to my 401k and $27,000 for a catch-up contribution if I'm over the age of 50. The state tax exemption, that also got an increase with inflation. I know in the previous proposals, they were talking about cutting that in half. That did not get passed. So that's good news for all of us. So right now that's currently $12,060,000 per decedent. So 24 and change for a married couple. One thing to note about this is it is still planned to sunset in 2025 from the Tax Cuts and Jobs Act that got passed in 2017. So right now it's over 12 million, your lifetime estate tax exemption, but in 2025, that's going to be cut in half to around 6 million. And then one final thing is the annual gift exclusion. So in the past few years, I would be able to give my sister $15,000. And by doing that, I wouldn't have to file a gift tax return. I'm excluded from that, and it doesn't reduce my estate tax exemption, which is that $12 million figure right above it. They bumped that up $1,000. So now I can give my sister $16,000 this year and no questions are asked. So some smart tax strategies for 2022. Backdoor Roth conversions are still alive. So this plays in well with my statement about the elimination of the backdoor Roth. For our clients, as most of you are, we're looking to do this if it applies to early on in 2022, because if they do pass legislation and eliminate this, we want you to get grandfathered in. So something that we're keeping an eye on. Health savings accounts are always a great vehicle to take advantage of if you're on a high deductible health plan, triple tax benefit, and with the continuing increase in healthcare costs, it definitely makes sense to store that money away for the future. Tax diversification, capital gains, dividends, tax loss harvesting. So as the market's taken a dip, this is when our investment teams kind of take advantage of the losses and using that to offset your gains. So what it boils down to is being proactive when the market takes a small drop to kind of set yourself up for success, offsetting future gains or lowering your adjusted gross income via a 3,000 ordinary income offset. Other ways, eliminate IRMA or Social Security taxation. So for those that are claiming Social Security and on Medicare, if you have a high income, you could possibly be subject to IRMA, which some of you maybe have seen that your Medicare premiums, Part B and Part D, have increased as a result of IRMA. So really being intentional with the tax projection is something that we can help you out with to make sure that we're not subjecting you to these additional unfriendly taxes. Then bunching deductions to maximize itemizing. So for those that are charitably inclined, maximizing your giving in 1 year via bunching deductions, and then taking the standard deduction in subsequent. And then finally, estate freeze strategies for eventual sunset of estate tax laws. I just touched upon this, but that Tax Cuts and Jobs Act is going to sunset in 2025. So maybe it makes sense to freeze the estate while we have this higher exemption level, the 12 million, before that exemption gets cut in half in 2025.
Okay, so to just kind of close this out, and we'll open it up to questions. So how can we help you? I mean, we kind of discussed this all the way through. So whatever we're doing at Anchor Bay, we're doing it in-house. We're using our own in-house portfolio managers who look at your portfolio, on a daily and weekly basis, and we tailor it to your financial plan, your cash flow needs, your tax situation. So we retain control over the timing of distributions and taxes and risk and things like that. So, that's important that, to know that we're keeping an eye on your portfolio every week. The investment committee gets together, we evaluate it, we talk to whichever planner you work with. They keep the committee apprised of your individual situation. And, we do everything in-house. Everything is kind of coordinated. We don't just do investing for the most part. It's investing along with financial planning. We integrate tax planning and tax preparation into it. So we try and do everything coordinated because we think we can get you the best results by doing that. And always, everything we're doing is because we really, truly feel that it's in your best interest. We're always acting as a fiduciary. So if you've got questions about your plan or your tax situation or anything, don't hesitate to reach out to myself or to Blake or to Tanner. Our contact info is on the last slide, and we're happy to have a consultation and talk more detail about your individual situation. But with that, we'll go ahead and take any questions. I know we ran a little long, but we felt this was a good time to do this presentation, especially given the volatility we've had this week. So you can use the Q&A function on the toolbar there to ask any questions you want to ask, and we'll be happy to answer them. Or like I said, if you want to shoot us an email or give us a call and ask your questions or discuss your situation in more detail, we're more than happy to do that. We're always available to give you advice.
So
let's
I was just going to say, while you type in those questions, I'll do a quick plug here. If we don't do your taxes already, we can certainly do them. Just let us know. For those that were doing their taxes, we're gearing up for that season right now, so we'll be reaching out shortly. But we want to let you know that's part of our offering here at Anchor Bay, is we can do your taxes. And this webinar is going to be recorded, so we'll get you out the recording early next week so you can reference it and review the content and material that was discussed today.
So there we go. We have our first question. Okay, so the question is, what happens if Russia invades? What does that do to the market? Yeah, and that's one of the the kind of potential tailwinds we had. I mean, a lot of that, I think, and Tanner, you can talk about it more. A lot of it depends on what actually happens. I mean, is it some temporary incursion, or is it a full-scale invasion that could potentially lead to to war? So a lot of it, I think, will depend on the severity. But Tanner, why don't you add your thoughts on what the whole Ukraine situation could potentially come about?
Right. Yeah, I think it's a really good sign that upon first news of this, the market completely ignored it. So we didn't see, if the market was going to react negatively, it would have done it on the first bit of news that we got from this. Now, of course, could it escalate to a point where the stock market perceives it as an issue? Yes, it could. But at least right now, the market has not viewed it that way and has remained, the volatility that we're seeing right now is all due to stuff that's in-house. It's all, inflation and what's the Fed doing and supply chain issues. Could it escalate? Could the Ukraine situation escalate? Sure, but I think that we'd have some indications before the stock market starts to move, if that were going to be the case.
And we have another question. Since index funds are so heavily weighted towards the top 10, does that make them a less than desirable option? If so, what's a good alternative? So it's not all index funds that have this issue, but there's been a trend to go from active mutual funds, et cetera, into index funds, which has kind of caused some of this run up in the certain stocks, et cetera. I think we do use index funds, and our preference is to use individual securities. Again, we can control the cash flow, the tax situation, all of that. But if we use index funds, I think, Tanner, we're typically going to use sectors or more broad index funds rather than something like the S&P 500. Or we could, there are index funds out there that are not weighted the same way. And so maybe comment on that.
Right. Yeah. The S&P. So the index fund we were talking about specifically before is the S&P 500, which is typically what people go to if they want broad exposure to the US stock market, right? If you just were saying, I want to invest in the US stock market, typically people go to the S&P 500. Well, the S&P 500 has turned into Apple, Microsoft, and Amazon, and Tesla, and these top 10 stocks are taking up so much percentage of that fund that the S&P 500, which used to be very well diversified, is now kind of living and dying with those top companies. Now, last year, all those companies did really well, so you were fine. The S&P was up 26%. But if those companies do poorly, and they tend to be correlated with each other, if they do poorly, then all of a sudden you're going to get hit twice as hard because you're so concentrated in those specific companies. And what we do at Anchor Bay, we don't have people in the S&P 500. We take, like Jim said, we either do individual securities or a sector approach where we invest in the materials sector and the tech sector, and we weight them differently depending on how we view the market is, how we view where the market is positioned. For example, we might start to take a heavier stance in materials or places, sectors that sell those hard goods, like we said. There's no materials company that's at the top of the S&P 500. So you'll get that diversification from us, whereas lots of investors try to go at it alone, and they'll use the S&P 500. Well, again, like we were just saying, the S&P 500 is now basically you're buying those top stocks, and the other 490 are basically irrelevant.
Yeah. So we had one more question. Why do you think the Fed didn't bite the bullet and raise interest rates now?
So I think what the Fed chairman, Jerome Powell, is trying to do is make it very smooth. And he's trying to give the market plenty of warning before he's doing anything, and basically hinted that we're going to raise rates in March. He did this back at the end of 2021. And I think the Fed is kind of thinking, okay, we said we were going to raise rates in March. If we raised it before, that's going to send everybody into a panic, and everyone's going to think we are in a worse situation than we initially thought. Whereas the market, I feel like in truth, is just kind of waiting until we see these interest rate rises, and that anticipation is making everybody kind of antsy. So, I think the general consensus from the market is that the Fed is kind of getting it wrong and thinking that they're trying to save the market and smooth out that interest rate rise on the schedule that they predetermined. Whereas the market's just saying, let's do it. We know it's coming. Let's just get the interest rate rises and move on. So I don't know why the Fed is sticking to their guns with this and waiting. Like I said, I think it's because they think if they move their timeline up, the market will react poorly. But I, in all honesty, don't think the market would. I think the market would want to see the interest rates rise because everyone knows it's coming.
And Tanner, could part of it be that they've kind of said all along they're going to start to unwind the tapering, et cetera, and maybe that plays into when they're not going to do anything till that gets done, which they also said, I think, is March. So
Yeah, they're not going to raise the interest rates before they finish tapering, but they could finish tapering whenever they want. So I don't know, the market is kind of saying, let's just get on with it, finish the tapering, raise rates, and let's go from there.
Yeah, I don't think they're in any rush. I mean, I think they're trying to take a gradual approach, and given this some of the uncertainty still with COVID and now this Russia business, I don't think they want to derail the economy and the market at this time, because people are still weary of what just happened. So they're not in a rush to raise interest rates. I think setting the expectations is going to do better for the market and make them not look like the bad guy.
yeah, so I don't see any other questions. If you do have them, again, don't hesitate, reach out to any one of us, and we're happy to answer them for you. We appreciate you guys taking the time out to attend our webinar. So our next one will be in February. I believe it's the 23rd, or it's middle of February. We'll send an announcement out, but it's going to be on Medicare and Medicare supplements. So we'll bring in an expert on that, because that's not an area we specialize in. And so we'll have a webinar on everything you need to know about Medicare and Medicare supplements by Bob Bernardo, who's a Medicare specialist. Blake will be sending out the invite along with the video in the next few weeks to let you know when that's going to occur. Everybody have a great evening, and we will talk to you soon. Thanks for joining us.